Hey there, I'm Dave Keller here with Market Misbehavior. A lot of discussion has been occurring recently about narrow leadership, right? The market moving higher, but not a lot of stocks really driving the move higher. It's really the mega cap sort of FANG stocks that are really getting it done. The average stock's actually struggling. Why is narrow leadership such a problem right now? So what does it mean when we talk about narrow leadership in the market? Well, besides looking at the S&P, the Nasdaq, sort of those main high-level indexes, we can also look underneath the hood at measures of market breadth to look at participation, but also look at the individual stocks and sectors and groups and themes that are working versus those that were not. What's happened here in the first quarter, now starting the second quarter of 2023, it's been a fairly narrow-led market. And what that means, particularly recently, is that a relatively small number of stocks are having a pretty strong 2023. But all the other stocks, for the most part, are sort of flat to down for the year. Today, we'll look at some of the charts that tell the story of a narrow market environment, narrow leadership, why that could be a problem. Before we get to those charts, by the way, if you like this sort of thinking about market history, market dynamics, and investor psychology using the power of technical analysis, won't you subscribe to my channel? Also, give the video a like if you appreciate it. We'd very much appreciate that back. Put a comment below. Do you agree that narrow leadership is a problem in this market? Yes or no, and why? Let me know in the comments. Now, we're going to look at a couple different charts. And first off, sorry for the sun. It's a rare sunny day here in the Seattle area, so I don't have a lot of great way to protect from it because it's usually not an issue as I'm recording videos. But as we're looking at the chart here of the S&P, we're looking at different asset classes, actually. So we have the SPY in black, which year-to-date is up about 7%. In red, we have the bond markets, the TLT, which is up almost 10%, about 9.6% year-to-date here the first week in April. Gold outperforming all of them, up about 10.7% over that same time period. Here we can see crude oil prices and the U.S. dollar both about flat for the year. So, certainly some noise here. The dollar had been stronger going into early March. Crude oil prices obviously came down, and then news out of a couple things, but really most recently, OPEC with supply changes actually caused crude oil prices to jump pretty quickly, and a lot of the energy space to move around a lot. So overall, how are stocks doing year to date? Well, besides the last 2 days where the S&P has come off a bit, overall year to date, not too bad, right? The first quarter, the S&P was up almost 8%. The bond market's up about the same amount, 7.5% to 8%. Gold prices outperforming a bit, almost 9% in the first quarter, and continuing up over 10% now here in early April. So what's the problem, right? If stocks are up, if bonds are up, isn't that a good thing, particularly with stocks going higher? Here's the problem. This is a visualization from ThinViz, which I think is really well designed, that talks about, really illustrates the issue with narrow leadership. What we mean about narrow leadership is what are the stocks that are actually generating those returns, right? Because the S&P and the Nasdaq composite Nasdaq 100 are very top-heavy indexes. What that means is you have a relatively small number of stocks that have a huge weighting. That weighting has changed over time, but on average, the top 10 to 20 stocks in the S&P 500 usually weigh about as much as the bottom 300 stocks. What that means is because those indexes are cap weighted, which means the larger stocks have a larger weighting and a larger influence on the movement of those indexes, the top 10 to 20 stocks basically amount to the same impact in the index as the bottom 300 stocks. That's why a smaller name like, I don't know, Waste Management or Agilent Technologies or PayPal or Discover Financial is a rounding error for the S&P 500 because Apple is such a bigger company when you look at the market cap relationship. So when you look at this particular visualization, which is scaled on market cap, so the larger the box, the larger the weight of that particular stock. Look at the brightest green are concentrated in the biggest squares, basically. And these are the FANG stocks, right? Microsoft, Apple, Alphabet, Meta, Amazon, and other FANG-like stocks like Tesla, Nvidia. These are really, for the most part, the brightest green is found in those biggest boxes. If you mentally sort of ignore the top left sort of fourth of this chart and just look at the rest of the heat map, what would you say about the year-to-date returns, which is the data we're looking at here? It's kind of mixed to down, right? I see a lot of red. I see a mottled look of some red, some green, some bright red, some bright green, but overall it's averaging out to sort of a flat, disinteresting or not that interesting kind of market. This is what narrow leadership sort of looks like. We have a relatively small number of mega cap names that are doing well enough that the major averages are actually holding up pretty well. What's interesting is you can actually, if you have a really good database, a really good set of data, and you can create your own data series, you can look at indexes and look at indexes, but take out the impact of some of the larger stocks. There are some ETFs that do that. So, for example, the SPXT, which I've now added to our previous chart and indicated here in pink, is the S&P 500, but without all the technology names. It's not perfect. Still has some of those FANG stocks like Amazon, but it removes some of those big ones like Microsoft, Apple, Nvidia, the semiconductor names all out of the picture. If you take that out, you can see that the S&P X Technology is up only about 2.7% compared to the S&P's 7% year to date. That's pretty meaningful differentiation for one quarter, right? It's almost over double, almost triple the returns year to date when you add the technology impact in here. Now, it's not just about the overall performance. If you look at the charts individually, you'll see how they also illustrate sort of the discrepancy between the FANG stocks, the big mega cap names that are working. For example, this is Microsoft. Look at the low in November, the higher low in January. Newer highs or swing highs, higher lows, and now recently making a new high for the year here in the last week. Overall, this is a chart in a fairly constructive technical pattern. Now, the concern for a chart like Microsoft is that it's testing the August highs right now around $290 a share. I would argue that charts like Microsoft that have had these pretty good runs, they've now traded up to a pretty significant resistance level. The S&P has not been able to eclipse its August 2022 high. Will Microsoft be able to do so? I think that's an open question right now. However, the chart of the Microsoft between the last 6 months and now has looked pretty constructive. Compare that to the chart of John Deere, which is a large cap name in the industrial space. Made a new high in November. So while the S&P was making a new low in October, Microsoft making a lower low in November, Deere was actually gapping higher to retest its 2022 highs in the fourth quarter. From there, though, it's gone lower and lower. So while Microsoft, Apple, while semiconductor stocks like the SMH ETF, while gold stocks are making new swing highs in the month of March and into April, Deere is actually making a new low. It's actually gone below its 200-day moving average so far this week. So the challenge right now is the indexes are holding up okay. Some of these mega cap technology names are actually doing very well, but the average stock is starting to look a little bit more like John Deere than Microsoft, and that tells you there are some concerns underneath the hood. One more way maybe to illustrate this idea of narrow leadership is look at large caps versus small caps. This is the IWM, which is the Russell 2000 ETF. Look at how the last year has essentially been a sideways pattern, right? You call it a rectangle pattern or a basing pattern. And a rectangle basing pattern basically just means you have a fairly consistent level of resistance around $195 to $200 a share, and you have a fairly consistent level of support around $165 to $170. The IWM over the last year has basically been range bound between the upper end and the lower end of that base. Now, right now, it's actually gone back below the 200-day moving average. It's failed to go back above the 200-day, and now it's once again testing support around 170. So while the S&P is actually currently testing its February highs above its 200-day moving average, a lot of charts look a little more like John Deere, and they're really speculative stuff, right? Think of the small cap index as including more higher beta, higher risk, but higher potential return. More risky bets are actually in a fairly weak position below the 200-day, failing to overcome resistance. So while the S&P and some of those mega cap names are actually holding up pretty well from a technical perspective, there are a lot of John Deere's out there, and the small cap index is actually looking pretty weak as well, which tells you there's not a risk-on environment right now. It's more of a risk-off environment. That is how I would describe narrow leadership, using heat maps, using charts, of the S&P, charts of the S&P X technology, which shows you the impact. Those two things show you really the impact of those FANG stocks, those mega cap technology, consumer, and communication services names on the performances of our benchmarks. Why the weakness in small caps and the weakness in a lot of industrials, materials, and a lot of other sectors like financials, the weakness in those sectors really are reflected in stocks that are not testing resistance, but failing to hold resistance, failing to hold support, and now starting to break down. This is why a narrow leadership sort of market, like I think we're experiencing now, speaks to uncertainty and really the challenges for a sustainable market further beyond these levels. What do you think about this analysis of a narrow market? Would you agree with that assessment of the narrow leadership and the challenges reflected in weaker charts like John Deere and the small cap index? Let me know in the comments below what you think and if you look at it a different way. Also, don't forget to give the video a like, subscribe to the channel if you could. We'd love to have you along this ride with us. I'm Dave Keller with Market Misbehavior, and I wish you well. Bye now.